Hi, my name is Gerald Panneton. I'm chairman and CEO of Terra Resource Corporation. We're involved in the Yellowknife Camp. It's an old camp that has already produced 14 million ounces. It's located in the Northwest Territory of Canada. And I'm delighted to be able to give you an update with Crux Investor today, June 27th.
Right, Gerald, good to have you back on. Gerald, good to have you back on the show. We are in a really difficult market for precious metals. It seems like no one cares, despite what the economists are pointing to. No one cares about gold. It seems you've chosen recently to raise some money. I want to understand why. Why now? What are you going to do with it? And I asked that of someone who's created $1 billion of value. You built mines. You chose this project. Why is it going to work?
Well, thank you, Matthew, for asking these few questions. First of all, I'd like to go to cautionary statement and different disclosure statement. Everything is on the public domain, and you can find this presentation on our website at any time. And you can also reach out if you have any further questions. To answer your question about the recent financing we did, junior like us need to raise money. Unfortunately, sometimes it's a difficult time to raise money, and we have two options basically as a junior in this current difficult market. You stop doing anything, and you wait a year, 2 years, 3 years on the sideline, or you basically believe in your project and you want to keep working at it and keep adding the ounces. So the moment gold goes up, then you're in a very good position to have demonstrate what you found. Of course, if we had a different money supply, we would be a lot more active and aggressive. So we're focusing on our best target. We have a very simple, safe strategy. It's very simple. The reason we are in Yellowknife, it's because of the Campbell Shear, who produced 14 million ounces of gold. It's a district scale potential. 70 kilometers straight line. A property that covers more than 900 square kilometers. An option to acquire 100% of the Con mine, which produced 5 million ounces at 16 to 20 grams. We execute. We've been drilling $23,000, and this year we're probably going to reach 35,000 meters. And that's the reason we raised the money. The money was mainly raised for drilling. And of course, our resource keep growing. We're going to be approaching 2 million ounces eventually. And because we have a track record of finding and building mines, we know how to proceed. Of course, you could put everything aside. But at the same time, if you can keep working, yes, it's more dilutive. Share price is not the best, but at least we keep generating news. We keep targeting our best target, which we will be talking a little bit more about it, because the Campbell Shear is a high-grade target, and that express exactly why we are in Yellowknife.
Tell me, I hear what you're saying about all of that, and you make some very valid and some very good points there. But if I look at your peers, a lot of them have chosen to just hunker down, do nothing, spend no money, raise no money, just wait. Why is that not a good strategy?
Oh, I think it can be a good strategy for them. It depends. I mean, for example, I signed a deal with Newmont. Over 4 years, I have to spend $8 million, which probably I will reach this year. There's no question. I have to find 1.5 million ounces to sustain buying the Con mine and assuming the liability in the future. So, yes, you can always say that. At the same time, I also did a partnership with a company from Australia to explore for our lithium potential, which means I don't have to put a penny. And I'm already receiving benefit from that farm out. And so this is already good. Now, deciding to wait is, I remember 2008 financial crisis. Our stock went from $20 down to $3 and in September 2008. But I had $80 million in the bank. Did you think I stopped working? No, I kept drilling. Did I stop marketing? Yeah, because there was no meetings to be taken until mid 2009. So yes, the gold price is floating at 1925. We are in Canada. We have access to a very, very good project. We can create value for our shareholders. But if you go on the sideline, you're not creating value. You're just saving value. So maybe this is where you can say, do you keep creating value or you go on the sideline? And I don't disagree with people who do that because they want to protect their share base and they want to wait for a better market to finance. For us, we've had that discussion and we want to keep focusing on advancing our project.
Okay, you want to advance the project. The market's not kind of really giving value to anything. I'm looking at producers who are producing cash who are like 40, 50% undervalued from their highs. It's a tough market, right?
Oh, yeah.
What would you say to investors looking in at this moment in time as to, why should they even think about investing in you now? Why is this a better project than it was a year ago? Is it a better project than it was a year ago?
Of course it is. In my mind, it's we've already, in September, added 540,000 ounces at 8 gram near surface. Okay. So in my mind, we've already achieved part of our objective with the acquisition of the potential acquisition of the Con mine. Now we're focusing on high grade, which is a plus. Okay. It's not going to be a big use producer. It's not going to be a 500,000 ounces producer. But the requirement for me, high grade means less capital, better margin. And I've purchased project through my career. I've been in this business for 40 years. And some of the project, the most recent one in my mind is that I bought the Detour Lake mine for $75 million at a price of $50 an ounce for 1.5 million ounces that was left on the mine from a small junior Pelangio mine back then in 2006. I put it in production in 6 years and found 30 million ounces. But at the beginning, I paid $75 million, $50 an ounce. And currently, our resource in town, which is within 20 kilometers of Yellowknife, is worth probably about $8 an ounce. This is where I see a big discrepancy between the value of project 10, 15 years ago in today's market. Not only gold is at a very decent level at $1,925, but it's also giving you a very good margin. You probably could operate all in on a high-grade deposit at $1,200. So your margin is $500, $600 an ounce. But of course, we're not built. We haven't not built a mine. And how many ounces do you need to put it in production? And my answer is, I need 2 million ounces. And I'm not that far from that. And that's why our focus is very important. You see, when you look at the next slide, you look at the importance of, that's a snapshot of the Con mine. Completely reclaimed now, but with excellent potential to add ounces. You have airport, road, workforce, you have everything. And we're drilling, I could show on the map, we're drilling in this area here, a drill hole that target the Campbell Shear, where you can see the trace on the slides. So how can we, and I'm just gonna jump quickly to the next slide where I wanna show our earlier exploration has already found 540,000 ounces in this upper box here that you can see. The Camp 1 and Yellowknife potential. Just the Yellowknife zone is about 350,000 ounces at a grade of 8 grams, but very close to surface. So I've already assumed in my mine plan, if I was doing a PEA, that I have already looked after the first 5 years of operation of the mine by going near surface, which allows me now, okay, to go at depth, where I believe the potential, and remember, this mine stopped at 1,900 meters elevation. How deep is the La Ronde mine in Quebec? 3,400 meters. This is an Archean gold deposit along a major shear zone, named Campbell Shear, which produces 14 million ounces, which is open to the south, open at depth, and just need to be drilled. So a lot of people, sometimes they may say, well, I'm going to sit down because the market is bad, but maybe they don't have any targets. I do have very good target. And just to give you an example of that target, how about 534 gram over 20 meters? 80 gram over 7 meters. This is the down plunge. This is where I'm drilling. I'm drilling down plunge. This zone actually has not been mined because they shut down the mine before they could mine it. They just started developing it.
You've given me a couple of examples there of Canadian mines which go very, very deep. Obviously, if I think of deep mines, I'm thinking high cost environment, affects the margins, but you've got that grade. You have got that grade that you're chasing, and I guess financed by the kind of high grade stuff, shallow high grade stuff as well. So why not go and find more of the shallow high grade stuff? Why are you chasing this deep stuff? Why is that a good strategy?
It's a very good question, Matthew. I mean, would you, and recently when I was raising the recent financing with our shareholders, some of my shareholders said, you're drilling a hole that's going to cost $1 million? Are you kidding me? You have to look at the potential of the Con mine. I don't want to have a decision through, I don't want to wait 5 years to decide what I'm going to do with the Con mine. I signed the deal in November 2021, and I give myself 2 years to find out if I can find 2 million ounces more on the Con mine. So think about it. The Con mine has already left 650,000 ounces at 11 gram in reserve and resource when they shut down the mine at the end of 2002. So the reserve statement was 650,000 ounces at 11 gram. It doesn't mean everything can be mined, but I can tell you there's still a very good potential. Now we focus on surface and we're able to identify 500,000 ounces, which gives us the first 5 years of the mine at a rate of 1,000 tons per day. Where is the next 2 million ounces I can find on the mine? Because the threshold to put back the Con mine in production, say, is 1.5 million ounces at between 7 to 12 grams. Of course, at depth is more expensive. Your cutoff grade change. But you know what is good about the bottom part of the Con mine? It's free milling. You're getting 95% recovery. There's no more refractory ore. It's a very rich mine at the bottom, as expressed by those 20 gram over 7, 22 over 12. You can see it. Of course, you're not going to repeat 534 gram over 19 meters all the time. The section right above is 80 gram over 7. But that's the nature of gold. This is the nature. When you have high-grade gold, you do not have great continuity of the high grade, but you still have great continuity of the ore zone. And yes, a deep hole is more expensive. The operating costs will be more expensive. But remember, I do have a shaft that goes down to 1,900 meters that was commissioned in 1977. It's a concrete steel shaft, and it can be rehabilitated with a much less amount of money than building a new one. A new one will cost $150 million. So the benefit of the shaft allows me to have a target area at depth. You take the Robertson shaft out of the slide, and I don't do the drilling. Because there's an existing access to this deep ore, it makes sense to drill it. What I'm trying to say is that, yes, it's $1 million hole, but from this master hole, which I can show you basically where we are at now, we're currently at 1,700 meters. This is the dark blue line. This is all GT M23055. We intersected the Con shear that was supposed not to be there at that depth. It was supposed to be cut off by a granite. And we intersected a 22-meter zone. And as you can see, our target location now is 2,100 meters. It's going to start. So we're getting close. And from this master hole, we intend to add many different holes and have different wedges, which we'll be doing eventually. And you can see exactly where we are at now. Actually, we are, as of yesterday, over 1,600. When I put the slide together, we were at 1,570. The hole is progressing very well. We intersected the Conch shear, which gives us a new zone, which we can explore, which is above 1,000 meters. People have to realize one thing. Being in Yellowknife is like being in Timmins with 20 years of non-exploration. It's like being in Val-d'Or with full control of the whole camp. This is what Gold Terra is. Like I said, this is one target. This is a prime target because you have in-ground infrastructure and a surface lease. I will not have to permit a lot of things. The only thing I'm going to need to build is a new mill, which I may build out of town. But the access on the ground of the whatever you talked about, the C1 shaft or the Robertson shaft, are tremendous. These are very, very good access. And if the Conch shear is open at depth, we're going to be able to have more gold. So when you look at the potential of Gold Terra in Yellowknife, it is a real potential in an existing camp that has already produced 14 million ounces, over 5 kilometers of strike length, when the shear is 70 kilometers long. Like I said, if you give me your credit card, Matt, I'll find you 5-10 million ounces.
Okay. Let's talk.
I hope there's no limit.
No, there's a lot of money, but we should talk. Tell me that just in terms of just helping existing shareholders go, right, you've raised some money, usual complaint will be, so dilutive, why? Tell me exactly how you're breaking down that spend and how many ounces, where the ounces are coming from, and what's that time frame look like? I just want to know what's the impact of that raise going to be immediately for me.
Well, you can see very quickly, we had a winter program this year, and we did one hole at depth here. We focus on Yellow X North in this area. This is the 540,000 ounces of gold that we found in the first, say, 23,000 meters of drilling we've done. It cost us $6 per ounce to find that. That was the cost of our first MRE on the Con mine. Now, our next target is below the mine and also below the northern part of the mine. Okay, so we have two more targets. And so basically, when you ask yourself at first, before you start drilling the Con mine, you said, how many ounces can I find near surface? How many ounces can I find on the whole property? The property is not very long. The property is like 5 kilometers strike length at the most. And we control the ground to the south, and we control the ground to the north of the giant mine. So when you look back at this property, when you look at, we have 1.2 million ounces of gold in the 4 square that are north of town. And we're focusing on this purple property here, which is the Con mine. And of course, then you get into town, you get into the giant mine. The Campbell sheet keeps going. And the reason there are so many gold deposits in the area, which are not necessarily strictly related to the Campbell shear, but you can still find another Campbell shear of 10 million ounces north of town. But it was not, when we rate target as geologists and we present a budget, you need to prioritize your target. We're doing the same thing here. What is the most mature target, easy to drill, that we have on the property? And also, the fact is that on the Con mine, I can drill 12 months a year. But I go north to drill at $200 per meters, which is one of the reasons. You see, cost of drilling and operating costs are very, very synonym. They're very comparable. If your cost of drilling is $200 per meters, you probably can run your mine below $1,000 per ton of operating costs. But if your drilling is $500, $700, $800, $1,000 per meters, your operating costs will be higher because you're remote. There's so many advantages to be in Yellowknife and discovering gold. This will be much easier to put the mine back in production because you're right there with hydroelectricity, with workforce, and everything that comes along with it. But at the same time, to be able to purchase this mine, take the liability, which is currently the slide we are on, which shows basically what are the different parameters of the agreement. We need to find 1.5 million ounces. It's not about the spending. It's mainly finding 1.5 million ounces. And I have 4 years to do that. I'm only in the second year. And when I compiled the whole property, I realized how much the potential was there at surface. And already, like I said, in our strategy, accounted for 540,000 ounces at 8 grams, at the 3.5 gram cutoff grade, which means near surface it's possible. But where is the next million ounces or 2 million ounces target? Is right there on page 12. It's below the mine. And that's why I'm testing it.
Okay. Well, when do you start drilling? When do we expect information from you?
We already express to the market and the public the progress of the hole and the intersection of the conch here with some pictures that you can see on the slide 14. When the hole was roughly at about 1,100 meters, that was about 3 weeks ago. Now the hole is at over 1,600 meters, and we expect to hit the zone roughly at 2,100 meters. We expect to enter into the Campbell Shear, and the hole will finish probably in the 2,600 meters. And so sometime during the summer, we should finish the hole and get the assays and update the market with this. And from this master hole, our intention is to go back about halfway through at 1,200 meters and start Navi drill laterally to intersect the Campbell Shear north and south of the master hole at the same elevation. One of those 3 holes will be the best of the 3 holes. We will be starting to move the wedging or the Navi drill going up to look and have more intersection into the discovery.
Right. Well, in which case, we will wait to hear from you. I'm glad you got the money raised in this market and you know exactly what you're going to do with it. The strategy is obvious, and we look forward to hearing from you. Thank you very much.
And don't forget, next year we'll be exploring the Campbell Shear and other gold high-grade target north of the town. And we look forward to have a very successful drill program next winter.